There is a number sitting in your bank account right now that the government is watching. Not because you did anything wrong, not because you are under investigation, but because the way the American banking system is built in 2026, certain balances trigger automatic federal reporting. Certain balances put your money at risk in ways most people never consider, and certain balances are quietly losing you thousands of dollars every single year while your bank earns that money instead of you. I am going to tell you exactly what that number is. I am going to tell you what happens when you go above it, what happens when you stay below it, and most importantly, I am going to tell you where to move the money that should not be sitting in your bank account right now. Because here is what most people do not realize. Keeping too much money in a standard bank account is not just a missed opportunity. In 2026, it is a financial mistake with real consequences. And the people it hurts most are retirees who worked 40 years to build up a nest egg and are now quietly watching it erode while their bank pays them nothing. My name is Alan Cole. I spent 12 years working in retirement tax planning, and the single most consistent pattern I have seen across hundreds of clients is this: good, careful people sitting on money they worked their entire lives to save, earning next to nothing on it, exposed to risks they do not know exist, because nobody ever sat down and explained how the system actually works. That ends today. Let me start with the number everyone asks about first: the $10,000 federal reporting threshold, because this is where most of the confusion lives and most of the bad advice comes from. Under the Bank Secrecy Act, your bank is required to file a federal report called a currency transaction report anytime you make a cash transaction that exceeds $10,000. That report goes to the Financial Crimes Enforcement Network inside the United States Treasury Department. Your bank files it automatically. You do not sign anything. You probably will not know it happened. Now, here is the critical thing I need you to understand. That report is not a problem. A CTR filing creates no legal jeopardy for you whatsoever. It is routine paperwork. Millions of them get filed every year, and the vast majority go absolutely nowhere. The problem is not the $10,000 report. The problem is what people do when they find out about it. Because almost every person I have ever talked to, when they hear about this rule for the first time, has the same instinct. They think, okay, I will just keep my deposits under 10,000 to avoid it. I will split things up. I will be careful. That instinct is a federal crime. It is called structuring, and it does not matter if your money is completely clean. If you deliberately break up transactions to stay under the reporting threshold, you have committed a federal offense with penalties up to 5 years in prison, and the government can seize your money through civil forfeiture without ever charging you with a crime. I covered the full details of the bank reporting rules in my last video, which is linked right there in the description. But today I want to talk about something different, something that applies to every retiree regardless of whether you ever make a large cash transaction. And that is the question of how much money you should be keeping in a standard bank account at all. Because the $10,000 reporting rule is not the real number you need to know. The real number is $250,000. In 2026, FDIC insurance covers up to $250,000 per depositor per ownership category at each insured bank. That is the limit. That is the line. Everything above that number sitting in a standard bank account at a single institution is uninsured. If that bank fails, the money above $250,000 is not guaranteed. Social Security Administration. Now, I know what you are thinking. Banks do not fail. That is not really a risk. And most of the time, you are right. The American banking system is broadly stable, and the FDIC has protected depositors since 1934. Since 1934, no depositor has ever lost a penny of their FDIC-insured funds. IAFF. But the word insured is doing a lot of work in that sentence. The protection only covers what is insured. And in the last few years, we have seen what happens when regional banks fail and depositors discover they had money above the coverage limit. It is not a theoretical risk. It is a documented one. So the first rule is simple: know your limit. Know exactly how much you have at each institution and in each ownership category. And if you are above $250,000 at any single bank, that money needs to move. Here is where it gets more interesting and more useful. Because the FDIC limit is actually more flexible than most people realize, a married couple could deposit $1 million at a single bank and have it all insured by separating their funds correctly. A single account in the first spouse's name covers $250,000. A single account in the second spouse's name covers another $250,000. A joint account owned by both spouses covers $500,000. And retirement accounts like IRAs get their own separate $250,000 limit on top of all of that. So before you assume you need to move money to a different bank, check whether you are using all of your coverage categories at your current institution. You may have more room than you think. But here is the bigger issue that almost nobody talks about. And this one applies to almost every retiree watching this video, not just the ones with large balances. The national average interest rate on a standard checking account is just 0.07% in early 2026, according to the FDIC. Meanwhile, you can easily get up to 4.00% APY or more with a few low-risk alternatives. That is 50 to 60 times the growth without compromising liquidity or safety. Internal Revenue Service. Think about what that means in real numbers. If you have $100,000 sitting in a standard checking account earning 0.07%, you are making $70 a year on that money. $70 on $100,000. That is not financial caution. That is giving your bank a $100,000 interest-free loan every single year. The same $100,000 in a high-yield savings account earning 4% would generate $4,000 a year. The same money. Zero additional risk. Just a different account. Now let me walk you through exactly where your money should be, depending on how much you have and what you need it for. Because the answer is not the same for everyone. Category 1, your immediate spending money. This is the money you need access to right now. Bill payments, groceries, medical expenses, everyday living costs. The rule here is simple. Keep 1 to 2 months of living expenses in your primary checking account. Nothing more. If your monthly expenses are $3,000, keep between $3,000 and $6,000 in checking. That is it. Everything above that immediate spending buffer is losing you money every single day it sits in a standard account earning nothing. Category 2, your emergency reserve. Every retiree should have 3 to 6 months of living expenses in a completely liquid, completely safe account that they can access within 1 to 2 business days without any penalty. This is your financial safety net. Your car breaks down, a medical bill arrives, the furnace dies in January. This money needs to be there immediately. High-yield savings accounts are still the most flexible way to grow this money safely in 2026. The best ones are paying between 3.80% and 4.20% APY, come with FDIC insurance up to $250,000 per depositor, no monthly fees, no account minimums, and instant access to your cash anytime. Internal Revenue Service. This is not a complicated move. Open an account at an online bank, transfer your emergency reserve, and start earning 40 times what your current bank is paying you. That is money you earn back by doing almost nothing. Category 3. Money you will not need for 6 to 12 months. This is where Treasury bills become extremely useful and where most retirees are leaving significant money on the table. United States Treasury bills are government bonds backed by the full faith of the United States government, exempt from state and local taxes, and easy to buy through treasurydirect.gov or simple ETFs. In 2026, yields on 3 to 6 month Treasury bills are holding around 3.60%. Internal Revenue Service Treasury bills are not investments. They are not stocks. They are not funds that go up and down. They are short-term loans to the United States government. You buy a T-bill, you wait 3 to 6 months, you get your money back with interest. That is it. The government has never defaulted on a Treasury bill in the history of the United States, and the state and local tax exemption is a detail that makes them especially valuable for retirees. If you live in a state with income tax, the interest you earn on Treasury bills is not subject to that state tax. On a high-yield savings account, it is. That difference can meaningfully change which option actually puts more money in your pocket after tax, depending on where you live. Category 4. Money you will not need for 1 to 5 years. This is where certificates of deposit and Treasury notes come in. Top 5-year CD rates are around 4.10% APY in 2026, while the 5-year Treasury rate is also approximately 4.1%. Both are safe, both are predictable, and both significantly outperform what any standard savings account at a major bank will pay you. Kiplinger, the CD option, keeps your money FDIC insured and ties it up for a fixed term. The Treasury option gives you the state tax exemption. Depending on your state tax rate and your situation, one may be meaningfully better than the other. Run the comparison before you decide. There is also a strategy called a CD ladder or a T-bill ladder that many retirees use to combine safety with flexibility. Instead of putting all your money in a single 5-year CD, you spread it across multiple terms. Some in 6-month T-bills, some in 1-year CDs, some in 2-year, some in 5-year. As each one matures, you reinvest. You always have money coming due at regular intervals, so you are never fully locked in, but you are still earning the higher rates that longer terms offer. Category 5. Long-term money you will not need for 5 years or more. This is outside the scope of today's video and depends entirely on your individual situation, health, tax position, and risk tolerance. But I will say this. If you have money sitting in a standard savings account that you genuinely will not need for 5 or more years, parking it in a bank account is almost certainly the wrong answer. And that conversation is worth having with a qualified advisor. Now, I want to address a question that comes up constantly. What about money market accounts? Money market funds invest in short-term, high-quality assets like Treasury bills and maintain stability while offering better yields than a typical savings account. The Vanguard Treasury Money Market Fund currently offers a 7-day yield of around 3.63%, and the interest is mostly exempt from state and local income taxes because it comes from qualifying United States government obligations. TurboTax money market accounts at banks are FDIC insured up to the standard limit. Money market funds at brokerages are not bank accounts and are not FDIC insured, though they are considered extremely low risk. Understanding which type you have matters, so make sure you know what you own. Let me also address the IRS monitoring question directly, because I see a lot of fear and a lot of misinformation around this. The IRS does not monitor your bank balance in real time. There is no threshold at which simply having a certain amount in your account triggers a federal investigation. What the government monitors are transactions, specifically cash transactions above $10,000, as we covered, and patterns of transactions that look like structured attempts to avoid reporting. Holding $200,000 in a savings account does not trigger anything. Holding $500,000 in a savings account does not trigger anything. The monitoring is about how money moves, not about how much you have sitting still. The risk from having too much money in a bank account is not government scrutiny. The risk is losing FDIC protection above the coverage limit and losing thousands of dollars a year in interest you never claimed. Those are the real costs, and they are both entirely preventable. Let me give you the simple framework to walk away with today. 1 month to 2 months of expenses in your primary checking account. 3 to 6 months of expenses in a high-yield savings account earning 4% or more. Money you will not need for 6 to 12 months in Treasury bills or a high-yield savings account. Money you will not need for 1 to 5 years in CDs or Treasury notes laddered across multiple terms. And anything above $250,000 at any single institution, either spread across ownership categories at the same bank or move to a second institution. That framework is not complicated. It does not require a financial advisor. It does not require any investment risk. It requires knowing the rules and taking about 2 hours to set it up correctly. The money you are leaving on the table by not doing this is not a small number. On a $200,000 retirement nest egg, the difference between a standard bank account and a properly positioned set of safe alternatives is somewhere between $6,000 and $8,000 per year, every year. That is money you earned. That is money you saved. That is money the bank is keeping because you never asked for it back. I put together a free guide that covers everything we talked about today, including the current best rates on high-yield savings accounts, Treasury bills, and CDs, the FDIC coverage calculator so you can check your own situation, and the exact steps to open a Treasury Direct account and buy your first T-bill. It is called the 2026 Retirement Cash Guide, and you can get it completely free at alancoletax.com/guide. The link is right there in the description below. Let me leave you with this. Your bank is not your partner. Your bank is a business. And the business model of every major bank in America depends on paying you as little as possible on your deposits while lending that money out at much higher rates. The gap between what your bank earns on your money and what your bank pays you is not an accident. It is the product. You are the product. Knowing that and doing nothing about it is the most expensive financial habit most retirees have. And it is the easiest one to fix. Send this video to one person in your life who has money sitting in a bank account earning nothing. A parent, a sibling, a neighbor, a friend. The conversation you start by sharing this video could be worth thousands of dollars a year to someone you care about. That is what this channel is here for. I will see you in the next one.